Hey guys, Stock Saturday, and it's a bit of a strange week for me. I'm sort of broadly in line with the markets, about 3% down, just under 3% down. S&P and Nasdaq are both down sort of just about 3%, so broadly in line with them. But this is mostly coming from sort of a few positions for me. The sort of the bulk of this portfolio, at least, has sort of held up pretty well. Stellantis in particular, sort of growing and growing at the moment, even in light of the strike in the US. So yeah, really happy with them. And Process sort of doing okay since the sort of share dividend and sort of dilution, sort of. But yeah, overall, fairly happy with this lot at least. I did sell about £1,000 worth of Porsche just to sort of give me the top up that I wanted to go sort of further into options, moving this over to Interactive Brokers, and I put that as part of sort of just my cash from the bank as well. That's not all share sales. So yeah, wanting to sort of, as I mentioned last week, go further into those, and we'll sort of see what comes this week. I was hoping to buy some yesterday, but the money didn't clear in time. So yeah, we'll see where that goes. A little bit more Porsche still sort of available to be sold. I'm sort of keeping an eye on it, and Vanguard Emerging Markets. I believe that's sort of flitting between green and ever so slightly red for me at the moment. So it is sort of reminding me that could be a good time to sell. Not that you focus on your average cost, but yeah, just think sort of a position in the green at least. When there's potentially sort of rough times, certainly for China potentially, unless they do a hell of a lot of printing. Yeah, that may be on. It's on the consideration pile all the time. It's the ISA that's really sort of taken the hit this week. We've had Equinox Gold do a equity, a sort of convertible debt issue. So market doesn't seem to have liked that. I didn't think it was too bad. Can't remember. I haven't got the press release, but I think it was sort of 4.75% interest, which with Fed funds rate where it is, I thought was reasonably good, but it's available to be converted into shares, but at $6.30 in the future. So that's sort of, if the share price isn't there, then they're not going to convert at that rate. So it's sort of an incentive. So yeah, I didn't think that was a big deal really, but market sort of tanked on the news, and they're sort of using it to pay off existing debt and yeah, just refinance basically. If they had debt coming up for renewal, they had to refinance, so take the option now. But yeah, that's dropped. Some of the other gold and silver miners sort of dropped a bit, although Coeur Mining had a really good day yesterday. CleanSpark is now in the red for me in this ISA at least. Still green on the other one, but yeah, that's dropped down. And yeah, the REIT's sort of still bumbling around, not doing a huge amount, not liking the high interest rates. So it's not earnings season quite yet, but we still have sort of a fair bit of news happening. We had the big FOMC meeting from the Federal Reserve. That was Wednesday, and this is also the quarterly one, so you get the summary of economic projections. And yeah, there was sort of a bit of interest in there. You had sort of, compared to the June prediction, they've sort of revised their GDP predictions up quite sharply. 2023 they had 1%, they've now got 2.1%, so over double the growth they were expecting, and they've increased next year's as well to 1.5%, and then longer run, it's obviously never going to happen like this, 1.8% exactly all 3 or 2 years, and then longer term as well, but they have to put something in there, I guess. And unemployment they've also revised down, so they're not seeing a huge spike in unemployment. That's not even, not this year and not next year, expecting a 1% rise off the bottom. So your sort of 1% unemployment rate off the bottom would often indicate sort of rough times ahead. And yeah, they're not predicting that anymore. I think it got down to sort of 3.5%, and they're saying 4.1 is the top, where it was 4.5, basically saying we're going to have a recession. They're sort of, and they've fiddled about with inflation a little bit. They're sort of core PCE down slightly from what was predicted, and sort of up in the future, and headline PCE sort of moves about a little bit, but not a huge amount of change there. But the federal funds rate prediction, they're saying, so 5.6% is sort of, some members think there's a raise and some don't, so you end up at 5.6%. But next year, they were sort of predicting a 1% drop. 4 quarter point cuts potentially, or maybe a 0.5%, and a couple of quarter percents. But they're now 5.1% by the end of next year. I'm not convinced by this, I've got to admit. And 3.9% instead of 3.4% for 2025. I'm sort of firmly of the opinion that they can't afford this, because they've got a huge amount of debt rolling over, and sort of refinancing this from sort of what was probably 1% or 0.5% to 5 or over 5%. I just don't think they can afford it. There'd be, actually last week, they're at sort of 1 trillion in interest per year, and if they're refinancing it all at this without sort of barely cutting, then yeah, you could be looking at 1.3 trillion, 1.4 trillion maybe. I think that's just completely unsustainable. So kind of, I'm a big fan of Real Vision and Raoul Powell. He sort of has some theories of why they're doing this, and sort of potentially wanting to keep rates high, inflation to come right down further than it needs to, and then they'll sort of have excuses to cut the Fed funds rate, and then sort of reissue that debt after they've cut. But whether they'll have sort of enough time to do all this remains to be seen. But yeah, that was sort of some interesting predictions, sort of potentially signalling that they're very much thinking a soft landing now, that they can keep rates high, GDP still grows, inflation isn't too bad. So yeah, we'll see. Just sort of diving into the individual members, so they basically all agree on this year. You've only got 2 more meetings. Some are saying a cut, some are saying stay where they are. Next year obviously starts to get a little bit more stark. You had this, I've shown this before, the sort of one or two members being exceptionally high. You've got one member at 6.25%. This, it's a range of 0.25% for every vote, but that's basically saying end of next year 6.25%, which is quite a drastic move. And then sort of most of them at between 4.5 and sort of 5.5, but yeah, it's 2025 where they really spread out. You've got sort of one here at 2.75% and one at 5.75. So basically they couldn't agree on colour of sky, basically. And then 2026 they've now put in, and that's sort of, again, all over the place. Some people thinking it'll all be over and they're back at sort of 2.5% rates. Some people, presumably that person, thinking it'll still be high, and then longer run it all comes back down to normal, basically. But yeah, interesting sort of spread, and this sort of one super hawkish guy. We'll see if we're at if they're at 6.25% at the end of next year. I think I'd lay money that they aren't. As far as unemployment goes, it looks like they do all agree that that is looking a bit more rosy than it was. So the dotted line is sort of what they had in the previous one in June, and yeah, the bars are sort of where they all now see it. going forward. So for the rest of 2023, basically not seeing a problem at all. And 2024, some sort of had it very, very high and sort of some reasonably high, but certainly on average, this whole lot have moved back, sort of 1% basically, which is very bullish for their thoughts. And 2025, similar basically. Sort of average now being more around 4% rather than sort of 4.5%, which, as I say, historically has indicated a recession. So it's basically the majority of members now saying potentially soft landing, no recession, all the sort of buzzwords that everyone's using. So whether that means they're being too bullish and too confident, who knows? I don't think I talked about this too much. The sort of overhaul potentially of ISAs and sort of what they're talking about with pensions as well. Sort of Jeremy Hunt looking to get into rather a lot of changes. On the pension side, they're talking about investing or basically forcing pension companies to sort of set aside 5%, it looks like, to invest in basically complete startups from inception. Just sort of chatting on the Discord, I thought this was small caps, and it's looking like they're basically turning into a venture capital fund, and sort of having 5% of people's pensions in that. Maybe a little bit risky. Obviously, there's potential for higher returns than say having that in the FTSE 100, but yeah, sort of forcing people, or at least on the default option, your pension, you can always say, no, I just want to invest in an all-world stocks fund and be done with it. But yeah, for people that don't change, it's looking like they might be in that now. But on the ISA side, they're talking about sort of having potentially a bolt-on extra amount to the, say, 20k ISA limit. I'm hoping they're not going to sort of section off part of the 20k and say that's what this is for. If it was an extra amount, then that would be good. So say, I don't know, £5,000 maybe extra on the ISA limit, but it has to be invested in UK companies or London listed companies at least. And they're saying that could be a sort of potential way to get more regular UK money into stocks, which we don't really have. Sort of a lot of people in ISAs, certainly a lot of them are in cash, which is sort of saying at the bottom here. UK adults subscribed is deposited 12 million ISA accounts in 2020 and 2021, or that tax year, but the majority were cash ISAs rather than investment, which isn't sort of something the US do. They tend to put a lot more of their money in stocks. It's saying 4.2 million British people have over £10,000 in cash. Whether they mean in the cash ISAs or not, it doesn't really say, but yeah, and it doesn't say what their sort of overall portfolio is. That £10,000 could be a tiny portion of their portfolio, and the rest is in stocks. But sort of knowing people, knowing certainly my parents' generation, it was sort of, you had the majority of your wealth in cash, aside from your pension and sort of your own house, or maybe a second house. If people had super excess money, they might buy a second home, but they would never be buying stocks with their own sort of cash in the bank, if you like. They sort of think, I've got my pension, don't really know what that's in, and just leave it, basically. They would always sort of have the majority of their savings, basically, just in whatever highest interest savings account they could get, which isn't sort of great long term, really. And obviously Jeremy is trying to sort of push this forward, so presumably this isn't exactly going to affect the majority of people, since this is, you could already invest your 20,000 in UK stocks if you wanted to. This is for people that are already investing £20,000 a year and have more to save, so this isn't going to be a huge portion of the UK, but it might help at least. I would sort of certainly try and fill that while I can. So yeah, we'll have to see if this does go through and if there's any sort of restrictions on it, whether it has to be FTSE 100 companies or 250 or whatever it is. I'm not doing the startups that they're talking about in the pensions at least. But yeah, see what they do. So news for the week. There was quite a bit of inflation news. EU came out and was sort of largely in line, really. Year on year sort of figures coming down. Core coming down 5.3%. Still a bit high, but not looking quite as bad. A bit better than us, to be fair. And sort of headline was a bit lower than expected. Sort of their core and headline is practically in parallel, or was expected to be exactly the same. So yeah, not looking too bad for them, and sort of as expected. Unlike the UK, UK came out on Wednesday with a very, very sort of under-expected inflation figure. Core CPI for the month of August, 0.1%. So prices have barely risen at all. Obviously, people look at the year on year, which is good. 6.9% last month was expected to sort of trickle down to 6.8, and it was actually 6.2. So that's very good, but that is sort of what was happening a year ago. If you look at sort of the recent data, it's a little bit all over the place the last few months, but yeah, pretty good, or a good month at least. Let's see what sort of happens going forward. Headline was sort of a little bit higher as expected due to energy prices, I would think, mostly, and that will probably continue because it's got worse in September. But yeah, the monthly was negative last month and was sort of expected to be drastically on the upside, 0.7%, and was only 0.3, so that meant the headline actually come down where it was expected to rise. Only 0.1%, and again, people are saying, oh, it's 0.1%, it's barely falling, but yeah, what was expected to be back to an uptrend is sort of slightly falling, and with obviously the majority of inflation is not sort of commodities and energy and that sort of thing, it's houses and rent and sort of house related costs. So if all of that is coming down, we know house prices are coming down, so that sort of affects house sales and everything associated with house sales. And similar to the US, we are sort of a service-based economy, so if wage pressure is easing, which core CPI would potentially indicate, then yeah, could be looking good, and this sort of could be a short-term blip in headline inflation. People sort of thinking that oil rules the whole of the CPI basket may not be sort of quite so true. And then, yeah, you've had the Federal Reserve rates, sort of talked about those. They held sort of as expected, 5.5%. But then off the back of presumably those inflation figures, whether this was sort of a knee-jerk reaction to those figures, the UK held their rates as is, where they were expecting a 0.25% raise to put us in line with the US, presumably, because we sort of follow the US round like a lost dog. But yeah, it was expected to be sort of a 7-2 vote in favour of hiking, and it was ended up a 5-4 leave unchanged. So, as I say, whether that was a sort of a huge knee-jerk reaction to those figures, let's sort of just see how it's going. Obviously, these inflation figures are sort of potentially off the back of rate rises from 6 months ago, or even up to 12 months ago. So, if this is happening now, sort of raising rates and potentially causing even more pain in another 6 months, we could sort of potentially be going into a recession now, and they're sort of making things even worse in 6 months. So just thinking, hold where we are and see what happens, I guess. But yeah, good news, I guess. And I suppose backing that up, on Friday, the sort of UK retail sales didn't look particularly good year on year, sort of is still down. It was down last month, and month on month is sort of slightly up, but a little bit worse than expected. But yeah, doesn't exactly look rosy when you consider sort of part of 2022 was still sort of talking about COVID and sort of people not really going out all that much. You would expect sort of this August to be better than last August. So just back to the portfolio. This ISA sort of not really made a huge change. Clean Spark obviously a bit down, and Pan American Silver sort of still in the doldrums. Atalaya Mining doing pretty well. And on the interactive brokers side, Alibaba and Baidu sort of had a nice end to the week, but sort of still rumbling around this same range. And on the option side, I am actually down a bit, despite buying a little bit more. I think I've put probably £400 or £500 of the cash that I had in there into this, and I'm now at £500 down basically after putting that cash in. So that is mainly because of Equinox. The share issue has obviously dropped that down quite a bit and sort of lowered expectations for the future. So that's down about £600, I think. So you can see the sort of drastic moves that you can get in these options. I'm sort of hoping that that happens on the upside as well. Have to be sort of comfortable with it on the downside, which the sort of crypto background gives me that comfort, I think. Not really too bothered that this has dropped £500. They are sort of end of 2024 bets, and I am starting to look at sort of end of 2025, obviously. So yeah, we'll see where these go. Kerr Mining sort of doing reasonably well, considering it is sort of down in the low $2. Clean Spark come down a fair bit, with that now being under sort of or around about $4. And yeah, I finally bought some 2026 high max options, so that's not looking too bad, even though it's again sort of in the mid $5, although it did have a very nice bump on Friday. So yeah, I got £2,000 ready to buy up some more of these. Whether we see a sort of a bearish end to September and maybe a little bit more pain in October, I will carry on buying. So see where these all go. So like and subscribe, and leave your thoughts in the comments. See you soon.